What's up everybody, Gen X Dividend Investor here. In this episode I'll show you why dividends are more important than most people realize, with angles that even seasoned investors often overlook. Plus I'll show you a comment from someone who raged at me, calling me a liar and saying I was deceiving people, all because of something innocuous I said in a recent video. So sit back, drink a nice cup of Java, and let's start. Imagine a stock that was priced at $100 a share back in 2015, and then 10 years later it's still trading at $100. If its stock chart went sideways for 10 years, then many people would have the same reaction that my dad would have, which is that it must be a crappy stock. In fact, my dad would say that examples like that are why he doesn't invest in the stock market at all. My parents are actually divorced, and my mom also has nothing invested in the stock market. My dad would continue on saying that a 0% annualized return like that is obviously terrible, and that he could have done a lot better just holding his money in the bank, maybe in a CD, which is what he often likes to do. But a savvier investor knows that stock appreciation is only part of the story, and that you also need to find out if something pays a dividend, because even a flat stock can still produce good results if the dividend is high and sustainable. I mean, think of thin stocks with their higher dividend yields. Like this is Altria's last 10 years of dividend yield, and you can see that multiple times it's been around the 10% mark. So if that stock that had gone sideways was something like an Altria, and if you had bought when it was at about 10% yield, then you'd actually have made out okay. For example, pretend you'd bought one share of the sideways stock for $100, and let's assume that it kept their dividend flat, even though Altria has increased their dividend for many consecutive years. And let's also say that you weren't reinvesting your dividends. With a 10% yield, that's $10 in cash hitting your account every year. Over 10 years, that means you'd have been paid $100 in cash. Your total return percentage would be $100 of dividends divided by your $100 original investment, which equals 100% return over 10 years. And what would your annualized return be? I'm guessing that some folks would say that since the yield was 10% each year, they'd assume their annualized return was 10% per year, and in a single year that's true. But over multiple years, that dividend yield doesn't necessarily equal your annualized return, and in this example, it's actually about 7.18% per year. Why? Because getting a 10% dividend payout every year for 10 years without reinvesting adds up linearly, but your total return doesn't compound. And when you spread that total return over 10 years, your compound annual growth rate, or CAGR, is only 7.18%, not 10%. The formula for CAGR is ending value divided by beginning value to the power of 1 over the number of years minus 1. So our ending amount was $200, i.e. the $100 of principal we started with plus the $100 of dividends we got, divided by our starting amount of 100 to the 1/10th power due to it being 10 years, minus 1, which equals 0.0718, which is 7.18%. Now the math might be a little dry, but think about how amazing it is that that stock chart that goes sideways can still generate a 7.18% annualized total return using the numbers I used. Of course that isn't as good as the 10% the market has historically averaged over the long run, but it is still a much better return than the bank would have yielded you over that 10-year time frame. But now to amp things up even more, let's pretend you were reinvesting your dividends along the way. So you start with one share worth $100, and then you reinvested your $10 of dividends each year. After 10 years, you'd own roughly 2.59 shares, assuming you were reinvesting at that $100 stock price. That means your ending value would be 2.59 times 100, which equals $259. That would make your compound annual growth rate to be 259 divided by 100 to the 1/10th power minus 1, which equals 10%. So even a non-appreciating stock can suddenly look good if you are reinvesting your dividends and you maintain a good yield, and that's even if the company isn't hiking its dividend, which good companies usually do. Of course, if you were getting those dividends in a taxable account, then you may have some taxable income to deal with, or not if you're doing it in a retirement account. Anyway, we learned a few things from that example. Number 1, you probably shouldn't jump to conclusions about a stock just from looking at its stock price. Number 2, dividends can be a material part of your overall returns. Number 3, reinvesting your dividends can be a large compounding force. And number 4, which is that when someone says something like a 10% annualized return, they're almost always referring to a compounded return, not just a flat 10% yield. And that flat 10% yield, when not reinvested, grows a lot slower over time versus what a compounded annualized return looks like. Now you might be thinking something like, sure, if you talk about a 10% dividend yield, then dividends matter, but the S&P 500 average dividend yield is way lower than that, so do dividends really matter? And the answer is yes, and this chart proves it. From 1960 to 2024, 85% of the cumulative total return of the S&P 500 index can be attributed to reinvested dividends and the power of compounding, or 30% on an annual average basis. So if you had invested 10 grand into the S&P 500 in 1960 and didn't reinvest your dividends, your portfolio would have grown to 982 grand, which is awesome. But if you had reinvested your dividends along the way, then your portfolio would have grown to $6.4 million. Of course, past performance doesn't guarantee future performance, but hopefully now you understand how dividends probably matter more than you think. What you'll often find is that the worse the stock market does, on average, the more impactful dividends become, which kind of makes sense when you think about it. Like if stocks go sideways or down, then your stock appreciation is 0 or negative, but if dividends are being paid out, then they make up more or all of your return. That all being said, the best bet is to make sure you're investing in companies that can keep growing, because a growing company often can sustain and grow their dividend, whereas a weaker company has a higher likelihood of letting their dividend lapse. A growing company usually also gives you stock appreciation, as stock price often gravitates towards earnings, so you want to see your earnings trending up. Now, a question you might want to ask yourself is if we're headed into a decade of ongoing growth driven by AI and robotics, or if we're headed into some headwinds where growth will be harder to come by. The less we grow, the more conservative dividend stocks tend to shine, and when we do grow, those divvy stocks can still produce, but probably less than the market. Some people might think it's unrealistic to see a stock go sideways for 10 years, but then I'd point you to the S&P 500 from 2000 to 2013, where it did just that. That lost decade had lots of companies whose stock prices didn't do much, including Amazon and Microsoft. So tell me this, would you hold on to a stock if it didn't appreciate for 15 years? I remember talking to people about how I was holding Microsoft, and they said I was holding the bag, so to speak. But I felt good holding Microsoft because its fundamentals were trending well, even if its stock price wasn't. That's also why it's important to buy something when it's cheap rather than overpriced. Moving on, another reason why dividends matter more than you might think is that dividends are a real return. This is fundamentally different from stock price appreciation, which is unrealized until you sell the stock and can disappear overnight due to market swings. And that reality matters more than many people realize. I mean, a rising stock price depends on how other investors feel about a company's future. But a dividend doesn't rely on market sentiment, it's based on real earnings. The reality is that any company can go bankrupt, and if you haven't sold, then 100% of your investment can disappear. I've got some friends that happen to, so non-dividend stocks have some unique risks to them. But if you had been getting dividends from that company, then even if it went under, you'd still have recovered some, and maybe all, plus more, of your investment. Plus, dividends can be reinvested into other stocks or investments, buying more shares, diversifying, or taking advantage of market dips without having to sell anything. And because you're getting regular cash back, you're less dependent on selling at a good price. This lowers reliance on market timing, which most investors struggle with. Beyond that, because qualified dividends are taxed at long-term capital gains rates, they're more tax efficient than short-term gains or ordinary income, meaning you keep more of your return when you're paid through qualified dividends instead of selling shares early. Moving on, another reason dividends matter more than you might think is that they can help investors avoid emotional decisions by providing a steady, tangible return that they can focus on during volatile markets. When stock prices fluctuate or decline, receiving regular dividend payments reassures investors that their investment is still generating income, which can reduce panic and discourage impulsive selling. The ongoing dividend income stream can shift attention from short-term price movements to long-term business fundamentals, fostering patience and confidence. Now, you might still want to sell even if you're getting dividends, but hopefully you're selling based on logic and not emotion. But the truth is we're human, so emotion can easily come into things. Another key reason why dividends matter more than you might think is because companies that consistently pay growing dividends demonstrate a level of financial discipline that's often underappreciated. These types of businesses tend to manage their cash flows responsibly, ensuring they have enough to cover operations, growth, and shareholder payouts. A steady or growing dividend can indicate that management is confident in the company's long-term earning power. This commitment to return capital to shareholders reflects a mature, sustainable business strategy rather than speculative, short-term growth chasing. Now sure, sometimes flashy growth stocks pan out, but oftentimes it's the quiet compounding of reinvested dividends that can create substantial wealth over decades. And many investors underestimate how much dividends, especially when reinvested, contribute to total returns. Reinvested dividends buy more shares, which then generate more dividends, creating a powerful compounding cycle. This silent engine of growth can lead to exponential portfolio expansion over time, particularly for patient investors. What seems like a modest yield today can snowball into a significant portion of long-term returns without needing high market performance. And I've mentioned this before that despite their reputation as conservative or boring stocks, companies that consistently grow dividends have historically delivered strong risk-adjusted returns. Many investors assume that high returns come only from aggressive growth stocks, but data shows that dividend growers often outperform non-dividend stocks with significantly lower volatility. That's why I like to say that you can get rich slowly with quality dividend stocks. Another underappreciated aspect of dividends is that they can help you fight against inflation. What I mean is that companies often increase their dividends over time as their earnings grow, and often at a faster rate than inflation. Their dividend hikes can help offset rising living costs, preserving investors' purchasing power. Now, you've got to be careful that your company isn't routinely taking on debt to pay their dividend, nor is doing some other fishy financial engineering. But when a solid company continues to grow and return a portion of its profits to its owners, then that's the type of company I tend to like to invest in. Now, some people say that they can make their own dividend by selling shares, and to some degree they can. But they ignore the fact that selling shares lowers their ownership percentage of the company, not to mention that if the market is in a rut and stocks have crashed, then selling shares, potentially when they're severely underpriced, usually isn't a great strategy. However, if you aren't getting a share of the profits in the form of a dividend, then that's what you need to do if you're trying to get income. One thing that I think is funny that comes from the dividends don't matter folks is when they ignore that around 80% of the S&P 500 pays dividends. I mean, we just saw how Meta started paying a dividend and Google started paying one, and so did Salesforce. And I've said this before, but do you really think those brilliant minds and leaders would pay a dividend if they didn't matter? They pay a dividend because they ultimately believe it's beneficial for themselves and to their shareholders to do so. Clearly they matter, and it's silly to say they don't. Buffett often says the true value of a business is the cash it can generate and return to its owners over its lifetime. In the short term, stock prices mostly reflect sentiment or popularity, not intrinsic value. That's why even great companies can stay under or overvalued for years. So when a company pays a dividend and its stock price drops slightly, that doesn't mean its ability to generate future cash has changed. That drop is just a mechanical adjustment to reflect the cash leaving the company. Now, it's true that distributing cash reduces what's shown on the company's financial statements, and technically yes, that reduces the company's total value by the amount of the dividend. But if that cash wasn't going to be or couldn't be reinvested into high return projects or used to enhance future cash flow, then the company's ability to create value going forward hasn't actually changed. Intrinsic value, in the Buffett sense, is about the future cash flow potential. If that future earning power remains intact, then the company's economic worth, the part that matters to long-term investors, is still the same. In that sense, paying a dividend doesn't decrease the company's future cash generating value. But if a shareholder sells their own shares to manufacture their own dividend, perhaps from a non-dividend stock, well, that does reduce their ownership in the business, and with it, their claim on all future earnings. So while both actions generate cash, only one preserves your long-term stake in the company. So when someone says, you can just manufacture your own dividend by selling shares, to me it's kind of like saying getting a paycheck is the same as selling your furniture to pay the bills. Sure, both give you cash, but one seems more sustainable, consistent, and part of a better long-term wealth building strategy where you aren't selling your assets, assuming it's coming from a high-quality business. Anyway, another reason dividends matter more than you might think is how they reward long-term investors by compounding over time and providing increasing income from growing companies. And while the benefits of this strategy may take years to fully materialize, it aligns perfectly with buy-and-hold philosophy that often leads to better long-term performance. And that leads me to another key reason why they matter so much, which is that they encourage investors to think like business owners rather than traders. I mean, receiving regular cash payouts connects the investor to the underlying business activity, reinforcing the idea that stocks represent ownership in real, functioning companies, not just ticker symbols. Having that perspective often leads to more rational decision-making, focusing on company performance and fundamentals rather than market timing or speculation. And speaking to mindset, another reason dividends matter more than you probably think is that receiving passive income through dividends offers a unique psychological comfort that many investors underestimate. This removes a major source of stress and decision fatigue, particularly during downturns when selling feels risky or emotionally charged. I mean, knowing that income will most likely continue without any action on their part creates a deep sense of financial security and independence. It helps investors to remain invested, avoid emotional reactions to market swings, and enjoy the benefits of ownership without needing to time the market. A truly hands-off income stream that supports both peace of mind and long-term financial health. I've gotten to live that reality for 4.5 years now as my dividends have covered all my expenses, and it's truly been more amazing than I hoped. I know that even if I get hit by the proverbial bus, that my dividend income should keep flowing in for my wife and kids, and they won't have to know anything about stocks or the market for that to happen. They can literally just go to the ATM machine and take out cash that keeps piling into it. My Fidelity taxable account is set up to automatically transfer all dividends received to go to my bank checking account, which is where my bills automatically get paid. So my mortgage also is automatically deducted from it, etc. Now, a big caveat to all that happening is that my businesses need to keep performing, but at least my wife and kids don't need to log into Fidelity and pick some stock to sell and do a market sell order to generate cash flow. That matters more to me than I could express in this video, especially after all the health crap I've been through and my own realization that life is fragile and can end at any moment. So yeah, dividends matter a lot to me. I get great solace knowing that my family will financially be fine even if I'm not around, either literally or mentally, and I kind of feel like my dividends have a bit of my essence in them, and they'll continue my legacy and memories even when I'm gone. Kinda weird, I know, but it makes me happy. Another mindset benefit is that every dividend dollar paid back to you kind of reduces your cost basis in behavioral terms. Over time, consistent dividends mean you've recovered some of your initial investment, decreasing the amount still at risk. And to give you a poker analogy, dividends are eventually like playing with house money. I mean, imagine this. You invest $10,000 in a dividend-paying stock. Then, over several years, you receive $10,000 in dividends. Now your original investment is still intact, or maybe even has appreciated, and you've recouped your initial $10K investment. At that point, you're essentially playing with house money. Any future returns are pure upside. Your financial risk is psychologically and partially economically reduced. You've recovered your initial capital without selling because dividends paid you back. Of course, don't lose sight that your total return is still very important. But from a behavioral finance perspective, this payback effect can be very meaningful and often underappreciated. Now, with all that being said, the fact of the matter is that you have a lot of choices on how you want to invest. Do you want more stock appreciation? More current yield? More total returns? More safe investments that tend to yield less? It all depends on whatever you choose. And with that, I want to wind things down with a brief clip about choice.
My mom told me this: hate has 4 letters, but so does love. Enemies has 7 letters, but so does friends. Lying has 5 letters, but so does truth. Failure has 7 letters, but so does success. Cry has 3 letters, but so does joy. And negativity has 10 letters, but so does positivity. You always have a choice, so choose the better side of it.
That's not only about choice, but also about perspective. It's about how you choose to lead your life. You can focus on the negative or look for the positive. You can let your history and challenges bring you down, or you can choose to move forward. It's up to you. And what's also up to you is if you choose to answer this question I now pose, which is if you think dividends matter. Please leave me a comment with your thoughts. Moving on, now I want to close things off and show you a comment by someone who raged at me and said I was super deceitful and lying to people's faces about something I said in a recent video. So in last week's video called Population Declining, Why Dividend Stocks Should Soar, I was responding to a comment where someone said that dividends are irrelevant for 99% of people out there, and to counter that point, I showed an example of how a small portfolio could yield big results if the person was patient and compounded their reinvested dividends for many years. In that example, I used an inflation rate of 3.3% in my tool that was guesstimating how a portfolio could grow over multiple decades using values displayed in today's buying power dollars, i.e. adjusted down for inflation. Pretty innocuous stuff overall, right? Apparently not. Check out this comment I got. He goes, 3.3% inflation? Where'd you come up with that? The average inflation rate of the last 5 years was 6%, and with each financial crisis, they have to print more and debase more to keep up with the debt death spiral. It's super deceitful you make people believe in 10 to 50 years the average inflation will have been 3.3% during times where they have literally printed half the money that has ever existed in a fraction of the time. So I tried to de-escalate things and answer honestly, and the truth was that I googled what the historical average has been and got this data here, which said that from 1914 through 2025 we averaged 3.29%, so I rounded that up to 3.3% that I ended up using. I figured that was a reasonable amount given our history, which has had varying debt levels and crises and GDP and blah blah blah, and we had periods where we were much higher than the 9.1% we recently spiked to. Like in the 80s we got to over 15%, kind of like we did after WW2. I also suggested that he not use the last 5-year average as an appropriate representation of what inflation will be like for the next 50 years. Now, he was a Bitcoin guy based on his logo, so I'm guessing his rage was partially fueled by his probable view that the dollar currency is flawed and that Bitcoin is a superior alternative, i.e. the US dollar loses purchasing power over time due to inflation, especially when the Federal Reserve prints more money, which hurts savings and people on fixed incomes. He then responded to me saying, "You are using the average from a time when the USA wasn't 37 trillion in debt. How do you ignore this so blindly? You must understand that they have to print in each wave a bigger basket of money to sustain the interest payments on that." He then left a comment to a user named ParrotPDG who had basically said that this guy was angry. And Bitcoin Dude wrote back and said, "You're right, I am angry that he disregards a very critical part of how money works. You are literally being lied to in your face." And then Bitcoin Dude shared some data about the money supply growth in the USA. He left another comment saying, "It's pretty shady that you just Googled it and insist it's only 3.3%. Have you ever actually been to a supermarket or talked to someone older about what their grocery bills used to be? Or do you just blindly accept whatever you're told?" So I responded with the following. I said, "I'd suggest toning down the inflammatory language. That aside, 37 trillion in debt sounds alarming, but raw debt numbers don't tell the whole story. What matters more is the debt to GDP ratio, which has fluctuated significantly over time. For example, after WW2, the US debt to GDP ratio exceeded 100%, similar to where it is today, and the economy still managed strong post-war growth without runaway inflation. US GDP has grown substantially over the decades, so rising nominal debt isn't automatically catastrophic. The real concern is whether debt grows faster than the economy over time, and that's a far more complex issue than citing a single headline figure. As for the 3.3% inflation estimate, it's based on over a century of historical data spanning wars, crises, and policy shifts. It's not a prediction, just a long-run average used as a reference point. Moreover, current forecasts from reputable sources suggest that long-term inflation may remain moderate. For instance, this survey of professional forecasters predicts that the headline Consumer Price Index inflation will average 2.3% annually over the next 10 years, with PCE inflation averaging 2.11% over the same time period. If you believe inflation will be structurally higher due to future debt dynamics, that's a valid thesis, but like any 50-year forecast, it's ultimately speculative. Or to say that differently, number 1, relax dude. Number 2, I used a higher average inflation rate estimate for the US going forward than what many inflation experts currently project. Number 3, that being said, I also think it's reasonable to believe that the average inflation rate will end up being higher than what I used or what experts are thinking it will be, but like any 50-year forecast, it's just a speculative guess. If you watch my videos more, you'd know I often say things like, the further you go out with estimating, the less likely your numbers are to be valid, but regardless, saying that I'm super deceitful or lying to people's faces or I'm ignoring things blindly or whatever is over the top. And in that video I explained that debt is a problem that needs to be tackled better, and it can cause some very real problems if we don't get out from under it. And I wouldn't be surprised if inflation spiked in the short or medium term, but I'm also guessing that over the next 50 years we'll figure things out and bring it to manageable levels. Regardless if it's higher or lower, it wasn't some grand plan of mine to fool people into thinking whatever, so no need to get riled up over a video. Fortunately, it's only a very small percentage of commenters who rage at me, and I wish they'd realize that anger often makes it harder for others to hear their point. I'm here to have a good faith discussion, and if you've got a point to make, then engage in civil debate. You gotta realize I'm just a dude who is passionate about dividends and investing, but is also human, so I can make mistakes, and it's cool to tell me about them, but do it in a respectful manner. And with that, I ask you to kindly do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to shout out my newest Patreon aristocrats, so thank you to Sen Fodic, who just signed up for an entire year. I'd also like to thank JS, who also signed up for a year. Patreon aristocrats get access to my dividend spreadsheet tool, as well as they get to watch my videos before I release them publicly, and they also get to vote on which thumbnails I use in my videos. Plus, they get to hear about my buys and sells before anyone else does. I'd also like to shout out Gordon Smith, who just joined my channel as a member, which gives him a variety of perks. And now, as a way to show my gratitude to people who leave really nice comments, I'm going to shout out 10 subscribers who've done just that, and note these are from over a year ago before I was calling anyone out. So thank yous go out to Adam Lee 3317, Craig Sutton, Elias Raposo 327, E. Mickens 4, Jeffrey W 4867, who's left me multiple nice comments over time, Max Rotor 1, Michael Davis 5792, Middle Age Grind, Nerd 12, who's left me a ton of nice comments over the years, and last but not least, Ruby Green 1249. Now I'd like to pitch a few quick things, starting off with my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off the first payment even if they sign up for a full year. Also check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. Finally, please check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. And regardless, I recommend everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 85 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.